Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us right now, and this is a timely conversation because we're like, the stock market, we're all going to die, and maybe we look at gold. Mac Diczok joins us, head of fixed income strategy for Merrill and for Bank of America Private Bank. What's the level of sweat among your clients? And don't give me the Brian Moynihan answer, blah, blah, blah. Okay, what's the level of panic out there on a Friday?
Not that bad. Not that bad at all.
That's what we're hearing.
Retail has been surprisingly resilient, looking to put capital to work. We are not seeing panic, especially with regard to the equity markets, from most of the two-legged individuals or clients. They're reacting very maturely to this market environment.
Brian listens every morning, so don't sweat. But is it just because they think things and systems will adjust the Trump message from the White House and will move forward?
I think they have a very good ability, and they have had over the past couple of years, to sort of look through the noise. And at the end of the day, there is some obviously economic uncertainty here. And I know outside of certain sectors, certain geographies, there are not a lot of massive layoffs, right? The corporate sector is still not laying people off. So even if there's a slight uptick in unemployment from the lows, until you actually start to let people go, until you're afraid of your own job, your brother-in-law loses his job, your wife loses her job, until that happens, people are still relatively sanguine. And again, we're not seeing any significant sentiment changes from retail with regard to the equity markets, which is impressive.
All right, well, how about in fixed income space here? I mean, you can sit there at a 2-year treasury and get darn near 4%. Do you do that? That's not a bad living. Or do you take some credit risk?
So we don't think you need to take a lot of credit risk, but we would like people to certainly be longer duration than a sort of 2 to 3 year on average, right? The regular client should be around probably, I think, 5 to 6 years. It depends on the individual client. But at the end of the day, the bond market average duration is just over 6. We really don't want clients to be too short to whatever their strategic duration target is without a good reason. Again, a lot of clients are actually still, where you do have some concerns from retail clients, is actually the fixed income side. They get more worried about that. Having seen that bond bear market, the 18% drop 2020, 21, 2022 from the highs, that's concerned them. That's obviously a lot more likely from a yield of negative 2% real rates than it is at a roughly plus 2% real yields across the curve.
It's interesting. I mean, over the last couple of years, when I look at the Bloomberg fixed income total return screen, where I've seen the best returns has been with risk, high yield, leverage loans. Actually, and those two are actually underperforming this year. That's kind of a change, at least. Definitely
underperforming. Again, not surprising to see credit, both high yield and IG, underperform the index with equities. They have a higher correlation to equities. But again, for the retail client, it depends on your time frame. While you might see some market value changing in your corporate bonds relative to treasuries, spread widening, if you're strategically long credit year in and year out, you're getting that extra yield over credit losses, you'll get a better portfolio performance. So right now we're actually just kind of pulling our horns in on our sector tilts, neutral across sectors in fixed income.
Are you throwing a brick at some, advisor at Bank of America who goes back to Rote 60-40 strategy? Is it like a dinosaur, or is it germane today?
No. We do not think it's a dinosaur at all. Maybe I'm the dinosaur, but we don't think it's a dinosaur at all.
Right.
We had a lot of concerns, obviously, that bonds were no longer doing their jobs. You needed something else to replace equity, to replace bonds as diversified equities. Commodities was given as a particularly good one. We were never buyers of that. At those valuations we had a couple of years back, again, negative real yields, it's probably hard for bonds to work. The way I've described it for a retail client is you're in a 400-meter race. If you're 2% behind inflation, well, you're 50 meters behind the starting line versus commodities. Commodities are going to track inflation. If bonds are below inflation, you're not starting in a good place. You're not even 50 yards back. You're sitting in the stands. Now we've got bonds that are 2% on average, real, above inflation. So they're already beating inflation, and so they're ahead in the race. That's why they're diversifying. That's why they diversified in August. That's why they're diversifying now. They have the valuations where they can come down with any uncertainty.
What's the biggest mistake high net worth retail makes in fixed income?
Historically,
yield hog? Is it just that simple?
It's been the opposite. It's been the opposite. Again, for the past several years, the issue has not been yield hoggy. It's been afraid of duration. So scarred by those double-digit losses in terms of high-quality fixed income. That's where they've been reluctant.
2022 was rough. I mean, historically rough in 2022.
It was very rough. Again, when you're at negative 2% real yields, there are not a lot of good things that can happen, right? But that negative 2 to 2% move, that 400 basis point move in real rates, our opinion, generally speaking, that was the bond bear market.
Yep. How about, mortgage-backed securities? I'm seeing some of the best returns in fixed income and mortgage-backed securities. What's going on in that market?
We like mortgage-backed securities, generally speaking. Again, we're neutral across sectors, but within sectors, we do like mortgage-backs because what's the risk on a mortgage-back? You're always going to get your principal and your interest payment back. You just don't know when. If people prepay, you get more cash. Usually when rates are lower, you don't want it. Rates go up, the bonds extend, you get less cash flow, and you'd like to reinvest at higher yields. The bonds have already extended. Hopefully some of you have 2% mortgages on whatever properties you have. The bonds have extended already. Right. You're still getting the cash flow. So you're almost basically a flat yield on mortgage backs to investment grade corporates right now. That makes mortgage backs look relatively attractive, especially in a volatile equity environment.
With all the politics that's going on, folks, we're waiting for a conversation, our Anne-Marie Horton in conversation with a gentleman from the Netherlands, Mr. Rutte, now at NATO, the new leader of NATO. And we're looking forward to that here in about 4 minutes, we hope. We're lining up the antennae and the satellites and the Starlink. Matt Diczok with us with Bank of America. I look at this, and the number one thing has been the gift of cash. If you believe disinflation's in order, not the fear of deflation, but after the sticky inflation, there's a settlement of GDP, we get a disinflationary trend. Can you model cash back under 4%?
I believe you can. And if you maintain the idea that the Fed is focused on getting back to 2% inflation or very close to it, well then, no matter how aggressive fiscal policy is, it can't really change demographics. It's very tough to change the population dynamics. And so real rates, again, do they have to be 50 basis points above inflation? Probably not. In that range of 50 to 150, 1% on average, 1% over inflation, right? So then a 3% Fed funds rate, 2% inflation plus 1% real sounds like a reasonable place to be.
Really valuable on a Friday. Thank you so much. Matt Diczok with us. He'll be with us here again. Next time we'll talk rugby at University of Pennsylvania.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is a joy. As we had Sam Stoltzfus earlier, now we're really going to dive into the adjustments of someone who's gotten the market so right. John Stoltzfus, in correction, half correction, partial correction, has said, be comfortable, own equities. He's chief investment strategist at Oppenheimer this morning. Are you still a bull?
Yes, I am, Tom. Still a bull.
Why?
Very much because when we look at the way business is navigating these waters, the earnings season that just ended, Q4 earnings season, you've got double-digit gains in 7 out of 9 sectors. Only 2 sectors negative. One was double-digit earnings negative. That was energy, which figures because we're awash in oil right now. But the 7 sectors that were double-digit gains, it wasn't just tech and communication services. It was, you had good, strong value stocks in there. And value's outperforming growth right now. And we think it's, the market is dynamic.
Okay, well, let's be dynamic. Let's pretend we're on a couch 40 years ago. I'll do my Lou Rukeyser imitation, and you do your John Stoltzfus imitation. It's 8:30 at night. The world's turned upside down, and Uncle Lou's there having us calm down. How will corporations adapt to this maelstrom? What does securities research at Oppenheimer say?
Well, I think what is generally the thought here is that corporations have been under duress now for over 16 years at many points. We had the great financial crisis.
NVIDIA's been under duress?
Well,
come on, you're killing
not
me.
recently, but if you look at it over the last few years, I mean, it had tough times, and some of the other techs did But when you look at the markets and managements, how they've operated across the sectors, it's great financial crisis, the pandemic, the disruption of the global supply chain, the levels of inflation that were hit, the Fed policy tightening, no recession, the consumer is still spending. It's the resilience, Tom. That's what gives us the courage of our convictions at this point.
Some are concerned about the consumer there, John. We had some of the airlines earlier this week take their earnings down. We had some retailers like Kohl's take their guidance down here, maybe suggesting that all this uncertainty out there in the marketplace, the news, the noise, may be impacting the consumer. How do you think about that?
Well, Paul, without a doubt, we had the Fed raise 11 times and then on pause at 9 at the higher end, and just started to cut last September, just 50 bips September, a pair of 25 bips in November and December. So very much it's no doubt you're going to feel the slowing because people are feeling a pinch. But American consumers tend to move towards discount stores, private labels. We tend to keep shopping. The world criticizes for our love of consuming.
But what if, whatever the percentage is, 40, 50, 32%, the fancy people in America are keeping American consumption going?
Yes.
Does Oppenheimer think that is dented and that will push into a diminished revenue growth?
No, not at this point. We're still looking.
Can we get him to say something negative? Eric, come on. I need some negativity from Stoltzfus.
Well, to me, it looks like guitar prices are up.
Actually, on Reverb, hold on. Let's stop the show, folks, right now. We go to Paul Sweeney, disciplinarian.
Sure.
Should we have a joint guitar purchase this weekend where Stoltzfus and I both purchase separate Gretches?
I think you'd jump right in there.
There we go. Okay. Continue with John Stoltzfus, please, Paul.
There's a challenge. Boy, oh boy, now there's a challenge. But we have seen, and what happens if the tariffs affect Sitka spruce, coming in from Canada? There's all kinds of issues there that one thinks of. But the realistic thing is we think that we're moving towards a new globalization. We think probably a point where with all this pressure that's being put on by the tariffs, the fact that we are the consumer of the world in size, the rest of the world has overcapacity because over the last 40 years they've been building capacity. We think we'll come out of this okay. I think that, Schumer, for all I've heard, there's plenty of criticism today. I think he recognizes the fact that we need to move together to try to avoid a shutdown and come to some kind of negotiation. We're looking for cooler heads to prevail. And, in this case, I think Schumer showed him a cooler head.
I mean, Paul, the sophistication of YouTube live chat is killing me. Tanner, good morning. Epiphones for everyone.
Oh,
there you go.
Here.
Hey, John, I know at one point you had an S&P target of around 7,100. I think the highest on the street at one point.
You sure know how to hurt a guy, don't
so
you?
what are we doing here with this call?
Oh, that's a great one, Paul. What we're going to do with that is it's under review at this time, but we've got to figure it's very early in the year.
Yep.
There's been a very the dark pitch book. The negative thought really has been overly projected, likely. So let's take a look. We'll probably look at it and see how we go when we get into the second quarter.
John Stoltzfus with us with OpCo. We're thrilled he's with us. We're going to continue with Mr. Stoltzfus, a lengthy conversation this morning. Good morning on your commute. I know it's a Friday. People are starting to look at March Madness and that Sweeney's totally unfocused. What's his name sprained his ankle?
Cooper Flag.
Flag sprained his ankle. Sweeney had to be medicated with a double Tang mimosa this morning just to get to the show. There's lots of distractions. With John Stoltzfus, there's no distraction. John, I'm going to cut to the chase. And we're going to do this is for Global Wall Street right now. So you got a fan distribution, and a bull like you extends your x-axis. We've come down. You're going to get back to S&P 7100. I get it. You extend your x-axis out. Everybody in the game understands this. David Kostin and Goldman Sachs did a fan distribution of outcomes where they got down to a low single-digit probability, a center tendency out there. You pushed against that. Do you still push against a single-digit equity world?
I do. I still push against it, and I think that the reason why is where we are today is we are at a watershed period of innovation that can drive all sectors here. And it's not just about tech. It's about what tech can do for the youths. It's what it can do for healthcare. It's what it can do for repurposing buildings and real estate, for finding resources in consumer staples, designing products for consumer discretionary. This is a very, it's what is it? The Chinese curse is, may you live in interesting times. But the other side of it, for the optimists, interesting times can produce not just risks, but can also produce opportunities. And when we look in hindsight, because as you know, I've been in this business for over 40 years. It's going to be 42 sometime between May and July.
Oh, you're a new kid.
God bless me. Anyway, the thing is, I've been through every boom, bust, and recovery cycle. And generally, when we look back, hindsight in perfection says, gosh, if only we'd bought more, if only we'd backed up the truck when people get so negative.
Crash of 87, which was, we don't need to go into it now, folks. There's too much valuable time here with John Stoltzfus. Crash of 87, I walked in the door and she handed me a triple martini.
There you go.
She took it off of a normal martini glass and put it in a rocks glass.
Yeah, October 19th, we walked out of the New York Stock Exchange and went to the Pig and Poke or something. We had a couple of beers. That's what we did that day.
And guess what? Life went on.
Life went on, exactly.
3 months later, where were we?
Exactly, right back at all-time highs.
My aunt had turned 80 that year in August, and I learned a lot about investing from her. Her first phone call to me was, the first words were, Johnny, what should we be buying today? Mm-hmm. Yep. So that's where I come from.
Folks, bronze it. What you just heard there, what was her name?
Mary Stoltzfus.
Aunt Mary?
Aunt Mary.
Okay.
She was terrific.
In the canon of Bloomberg surveillance, bronze it to the memory of Aunt Mary. What did she say?
She said, Johnny, what should we be buying today? That was her exact words.
Paul, save us here.
I'll go to Aunt Mary again. What should we be buying here if you feel like the world's not coming to an end here?
Great question. Well, as you know, Oppenheimer doesn't let me talk individual stocks because I manage money for the firm.
It's Friday.
But I can give you the sectors, the worst performing sectors. The worst performing, I want to own consumer discretionary, infotech, communication services, financials, industrials. Those look good to me.
Yep.
You know, they're at the bottom of performance from the peak. Coming down there. And, you know, when it comes to healthcare, the youths, real estate, and staples, I think they've had their run now. They've had I think it's a little late to get defensive.
Right. I mean, a lot of folks are feeling like this pullback in the market is kind of a self-inflicted problem here with all the talks about tariffs and what that means for potentially growth and inflation. But that talk and that environment, I don't see that changing anytime soon.
Well, you know, I think it incrementally it can begin to change. I think the first thing is, hopefully, fingers crossed today, we don't see a government shutdown when they take that vote. That gets taken off the table. Then beyond that, you've got to figure that, you know, it was Bloomberg Intelligence that I think about a month ago said that if 25% tariffs were put in against Mexico and Canada, both of those countries would go into recession pretty quickly. And the thing is, the pressure of the constituencies here, whether it's from business or the consumers in all countries around the world, to different effects with these tariffs, will likely, we think, once again, bring cooler heads to the table, some kind of a deal to come out of it. And it's just that it's time for it. You know, it's not at this moment, but it looks like there's too much at stake to let things go to hell.
Right. Valuation, did this pullback here, has it made valuation attractive or maybe just less egregious for some people?
Well, I think for those who were thinking it was egregious, it's less egregious. And for those who thought that it was primarily because demand for stocks had gone up so broadly and people, you know, it's no longer cocktail party stocks that that the private investor is doing. They're looking to replace what used to come from Social Security and corporate pension plans.
Yep.
And with a 401k, you just get X amount in terms of that a contribution that goes into the thing. So people have to invest like institutions, and that gives a lot of support to the market.
Question that we asked Sam Stovall a couple times this week, John, and it's just simple. If with things beaten down, do you buy things that have gone down less, or do you buy things that have been beaten up?
I think it depends upon the quality more than anything else. So if it's something that has been really battered, happens to be good quality, good management, good prospects for the bounce. Otherwise, one thing you want to really emphasize quality here. It's so overused these days, but we do believe that quality of leadership in a corporation and ideas. And you can find those across market capitalizations, whether it's large, mid, or small,
Right.
with the large likely favored by the largest investor community.
I got to get this in. We got a huge response on YouTube to this. Thank you so much. I mean, come on. The Epiphone for $3,500 with a P90 pickups. Explain to Joe Pass the great jazz guitarist, folks, Joe Pass. Explain what P90s do, because all these kids out there, they're like Seymour Duncan, rocker. What do P90s do that give you that sound?
The P90 is a single coil type pickup instead of a dual coil, so it'll be more prone to buzzing and hum. But that said, it has a really good fat tone when you roll down the treble. There's a roundness and a very rich sound that you get. But I prefer a PAF type pickup, whether it was built by DiMarzio or Seymour Duncan.
John Stoltzfus, thank you so much.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're going to squeeze a 2-hour discussion in here with America's giant on trade. Douglas Irwin is professor at Dartmouth. He's absolutely definitive. We mentioned Adam Posen yesterday and Chad Bone of the Peterson Institute. It's real simple, folks. The must-read this weekend, The Incoherent Case for Tariffs. Doug Irwin, in what way is the White House incoherent?
Well, in several ways, unfortunately. First is just trying to justify what it is they're trying to do. What is the mission? What is the goal? What is the end game that they want to accomplish? Is it revenue? Is it bringing back manufacturing jobs? Is it reducing the trade deficit? Is it national security? It's all the above. And the problem is we just draw on an insight by Jan Tinbergen, an old Dutch economist who won the Nobel Prize many years ago. We're just saying if you have a policy target that you want to hit, you need an instrument that will do that. And the problem is tariffs can't achieve multiple objectives in this way without a lot of collateral damage. And so it's not clear what the administration wants to achieve first and foremost.
The Bible on this, folks, this is when Blanche Flower was younger, Slaughter was younger, Doug Irwin was like out of graduate school. Against the Tide in Intellectual History of Free Trade. Here's my book review. Shut up and read it. Doug Irwin, this morning I go to John Stuart Mill, 19th century early, and he's arguing about infant industries. It is if President Trump wants to bring infant manufacturing back to America. Can he do that? Is there is there a policy success template to work off to bring infant manufacturing industry back to America?
Well, it's interesting you bring up John Stuart Mill because we're talking about the 19th century. And of course, he refers to William McKinley quite a bit, another 19th century president who imposed tariffs to try to keep industries here in the United States. You can do it sometimes, but the cost can be very high. Many countries around the world try to reshore industries. So Argentina has a little bastion of manufacturing in Tierra del Fuego, of all places, that they've inculcated with tax subsidies and import tariffs. So you can reshore some industries, but the question is, at what price, at what cost to other sectors of the economy, and is it really worth it?
So, Professor, depending upon the day, the administration has different reasons for imposing tariffs, whether it's to, choke off drugs coming into the country or immigration, or some days it's trade deficits. I'm just not sure. But for trade deficits, let's just stick to the economics. If the U.S. runs a trade deficit with a particular country, is that inherently a problem? And if it is, do tariffs address that?
Well, generally, we can have a debate about whether reducing the trade deficit overall, not a particular bilateral balance, but the trade deficit overall is a good policy or not, or whether we should make that an objective. But let's say it is. Then the question, as you raise, is, are tariffs in a way of achieving that? And generally not, because when you impose tariffs, the dollar is going to appreciate and imports may go down, but exports are going to be hit as well because of the appreciation of the dollar. In addition, there's foreign retaliation. So yes, import tariffs will reduce imports, but then foreign tariff retaliation is going to reduce U.S. exports. So what we try to point out is that yes, there are policies that we can do as Americans to reduce the trade deficit. First and foremost, cut the fiscal deficit, because that is a big source of dissaving in the U.S. It's a big source of excess spending. And you might recall Marty Feldstein, way back in the 1980s, had the twin deficit hypothesis that the current account deficit is being driven in part by the fiscal deficit. And so that's one concrete thing we could do to end our reliance on foreign capital inflows and help balance our books on both sides in terms of the trade accounts and the fiscal accounts.
Do tariffs raise revenue for the U.S. government? Is that an efficient way to do that?
Well, it can, yes. So we get about 2% of the federal government's revenue today is raised through the tariff. But the idea that you could balance the budget or pay for tax cuts with a big increase in tariffs is really not going to work. And one of the problems is that imports are very sensitive to tariffs. So as you raise tariffs, the volume of imports is going to shrink. It's a tax base that's going to shrink and disappear the more you tax it. So that revenue is going to disappear. Once again, there's no alternative really to income and corporate taxes as a revenue-raising device for the U.S.
We are honored that Douglas Irwin is with us. I'll put out on social his Foreign Affairs article. I'm not going to mince words, folks. A subscription to the print Foreign Affairs magazine is literally the price of a fancy martini in Manhattan.
Okay.
And it is the Bible. You throw to your kids and say, shut up and read Douglas Irwin, shut up and read Adam and Posen, and on we go. There's a lot of people out there, Professor Irwin, that think fancy Ivy League professors are talking about a rigged system. And one way to start it is all the American corporations boosting up real estate in Dublin, so even Bono can't afford to live in Dublin anymore. Doug Irwin, comment on the free lunch of tax avoidance in Ireland by American corporations.
This is a really big issue, and you put your finger on something. When we try to use tariffs to adjust these things, we're sort of missing the boat. I'd recommend to you Kimberly Klausing of UCLA Law School, also affiliated with the Peterson Institute, who has pointed out, as many others have as well, that the tax code sort of pushes American manufacturers overseas. And so we have to resolve our tax system, our tax code problems, to bring back that economic activity and stop the offshoring of intellectual property, receipts, corporate income, and things of that sort. So just putting on tariffs isn't going to solve that problem, but the U.S. tax code can.
Please comment. And then the leadership on this, folks, came from William Klein, who was hugely influential for me. Doug Irwin, the president loves to talk about a bilateral approach, or even some would say a unilateral approach. William Klein would say we live in a multilateral world. Is the dreams and hopes of 1600 Pennsylvania Avenue going to discombobulate because we refuse to look at this multilaterally?
I think it's a shortcoming of their approach. And first of all, I mean, it has to start with sort of foreign policy and recognizing that we have allies and people that are democratic, market-oriented economies, and we're all sort of trying to achieve the same thing. They're not our enemies. There's a wonderful YouTube video of Ronald Reagan giving one of his Saturday radio addresses, which is almost speaking to Trump from the grave. It's talking about how our allies are and our trading partners are our friends, not our enemies. And we really have to work with them if we're going to confront the China threat and other threats around the world. So you can't alienate everyone and think that everyone's sort of taking advantage of you. There are countries with goodwill that we could work with cooperatively and improve the trade situation.
All right. Professor, thank you so much. And folks, I'm not going to mince words. Just buy Against the Tide. Just put it on a coffee table. You don't have to read it. Just put it there. It's cool. It's got a beautiful light blue cover and all that. Doug Irwin, thank you so much. At Dartmouth this morning.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Guess what, folks? This is really the most important discussion of the day. Sheila Kahyaoglu is with Jefferies, and she brings in bulletproof engineering cred along with her economics. It's on the airline industry. We're going to talk about the state of the industry now. But Sheila, I'm just going to cut to the chase.
Sure, Tom.
Every house on the East Coast is looking at the tri-state area. On my place, I've got a lovely place, folks. I counted 12 airplanes in the sky like a couple weeks ago, a record amount. Airline safety in Denver the other day, here the other day, the horror of what we saw in Washington. People are really falling apart in this. You've got engineering cred. Do you believe in the system?
I do, but I also think this is where our airline and defense coverage come into play.
Exactly. That's why we're here.
Yeah, I met with...
They didn't tell you it's a 4-hour conversation.
I think it's very important, with the DOGE cuts, which have impacted defense, whether it's the manufacturers or the service names, to realize how important government employees are actually to the system, within the system of the U.S. I understand a 5% headcount cut that exists at banks all the time, but to do it within government employees where we tend to be understaffed, the FAA as an example, air traffic controllers in Newark are understaffed, and we're flying 40% more passengers through that airport as an example. So to fire 5% of them in a blanket, layoff does not seem to make sense. And a lot of the companies that have been hit, SAIC, Parsons, Raytheon Technologies, Leidos, actually provide systems for the FAA.
Do those people, Paul's got the Gulfstream to Scottsdale here in a couple days.
He'll be fine.
Out of EWR, do the flight controllers have the power to say, we don't have enough people, we can't do our job?
I know both the former administrator, Mike Whitaker, FAA administrator, as well as Dan Elwell under Trump administration #1. I do think there's areas where we could cut air traffic controllers. Perhaps we don't need them from 12 a.m. to 6 p.m. when there aren't 12 planes in the sky above your backyard. But, we might have to fulfill more funding. And also technology. The data, there's a lot of data that the FAA has. We just need the technology to mine it. And so cutting these service contracts don't necessarily make sense.
Sheila, earlier this week, we had a number of the major airlines cut their earnings forecast, their guidance outlook. What happened? Because it seems like when I'm thinking back to the earnings last season, I didn't hear much talk about that. What happened in the last couple months?
I think the drastic change is what's scaring folks. So, and it wasn't one thing. That's what I think is concerning for folks. So first, it was the safety issues. So let's close up on that. Whether it was Delta or American, it put these airlines on a marketing hiatus where it doesn't make sense to put out, fly for free tomorrow. Second, corporate travel. We've seen that tightening, whether it's our clients as well, paralyzed by what's going on in the markets. They can't leave their desk, so it maybe prohibits a work travel trip. So corporates are tightening their budget and seeing a pullback. And then third, leisure. Everybody sees what's going on with the stock market, maybe pulls back on that last trip. And then fourth, federal employees as well, traveling less.
Paul, I just looked at the flight I always look at here, and it's down $1,000.
Sure.
Round trip over to Paris.
Yeah, but
it's on sale.
The euro's, not where it was a couple months
That's okay,
ago.
But I can get tariff-free Moet Chandon there.
Okay, very good. Sheila, talk to us about the airlines. Where are we in terms of capacity? Are they where they need to be, where they want to be? Because it still feels like every plane I get on is full. So
yeah, I think we're watching the data really closely over the next 2-3 weeks. So 40% of airline earnings are in Q2. So it's go time for them. Let's see what happens from March 15th through April 15th. April 9th is when Delta reports. But capacity, to answer your question, TSA volumes are up about 1%. Capacity is flattish. So we've seen capacity tighten. That's been the story of the last 8 months. But we're seeing capacity come in Q2. Obviously, prices are down. So airlines are trying to keep their profit levels, adding more capacity. That just exacerbates the issue.
What do airlines typically do if they do see a shift down in demand, whether it's just consumer uncertainty around tariffs or whatever? What do they do on the cost side to adjust for that typically?
Very difficult.
Yeah.
You don't have many variable costs. A lot of it is fixed. Your plane is fixed, your pilot's fixed, your schedules, your gates. So very little you could do. You could maybe add red-eye flying to add incremental opportunities. That's what Southwest is doing. But that's what makes airlines trade at 5 to 7 times PE. Right. 70% discounts to the market. Airlines have not been seen as the best investment vehicles because they have very little maneuvers they could pull.
Blue button, Detroit Lions button. Then let's start there. How frothy is the business right now? I mean, is it going into one of those ugly periods where it's tough to maintain free cash flow or even revenue pop?
think it depends on the carrier.
Really?
Yeah,
it's not an industry thing.
I think some will be better off. So Atlantic is still holding in well. Tom's still checking out his flight to Paris. I think Atlantic is strong, but how long does that last if all of Europe?
Pacific right now?
Pacific is okay as well. They have very limited capacity. Luckily, Boeing is not delivering many 787s. Airbus isn't delivering many A350s.
Your single best idea right now?
I actually think Boeing, despite tariffs, despite macro, despite everything.
Wow.
Folks were, the equity offering was oversubscribed when Boeing had $55 billion of debt. Now they're down to $25 billion in net debt. Stocks at the same exact price. Folks have waited 6 years for planes. Airlines are not going to cancel yet. And then the aftermarket, put in a GE or an FTAI. FTAI is a SMID-cap name I cover. It's been, hurt by a short report out there. So that's the other one I throw in.
Well, on Boeing, how do American companies, as United, Delta, the others that you know better than I do they want to buy Airbus? Or is it just like, we can't buy Toulouse, it's un-American?
No, they do. I mean, but the U.S. is only 20 to 25% of the skyline. It's not 50%.
Boeing's selling to who then? Who's their dominant? Who's their biggest?
It's interesting because
brand?
this is why I think Boeing's quite interesting, as well as Airbus. We have 175 operators buying planes in 2025. That is very well diverse across the globe.
Where is Boeing in terms of, I've been told by a lot of folks, what drives this name is going to be the number of deliverables on the 737.
That's all that matters.
Okay, so where is the company now, and where would they like to get to? And do you have confidence they can get to that?
737 is about 50 to 60% of their free cash flow. You have to assume defense holds its own and stops losing money. But 37, they were at 20 to end the year. They're now in the 30s. In terms of production, they're still in the 25 range. They're getting out of inventory. But we have 384 deliveries for this year on the MAX. For context, they did 600 at the peak, so well below that.
I got to squeeze this in. Is their financial integrity improved? Is the systems analysis of Boeing, I got free cash flow, negative 14 gazillion, another year, negative 14 gazillion, now negative 5 gazillion forward, and then finally they flip positive in 2026. What's the integrity of that guess?
It's defense. Defense has lost $3 billion. 777X has lost $4 billion development programs. And then, of course, you had the strike. You had delays given Alaska.
How is it
so you gave away free aircraft.
How is it turned around? How'd they fix the damn rivets that fell out of the airplane?
It's interesting because I was in Charleston 3 weeks ago. That's where they manufacture the 787s. They do the 37s up in Seattle and Renton. Got reported by a Boeing employee for my shoes not being suitable for the factory floor. And I was like, this is a very stark change to how it's been. They're the FAA is integrated into.
Wait a minute, were you wearing Christian Louboutin? Well,
I was wearing, I won't give the brand, but I was wearing
Please,
flats.
It's surveillance. Give the brand. We do luxury.
Yeah, no, it was ballet flats. And so.
They wouldn't let you on the floor with ballet flats?
They gave me an exception, but I was scolded.
You need a hard toe thing.
Do you buy them? Okay.
Yep.
Do you buy the ballet flats on Madison Avenue at a store? If you go in the store, you can only come out with 3 boxes. I've learned that.
Yeah, but they
wouldn't let you on the floor in ballet flats?
Nope. I had a solid talk about appropriate
Well, that's good.
manufacturing
That's
shoes.
what you want to see, right?
So that comes back to my engineering. I gotta step it up a notch.
The new Boeing, that's all I could say. Sheila, thank you so much. Sheila Keaglu with us with Jefferies. They're managing, and I love it. The real engineering integrity there on the aviation business.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.